Welcome back to Investing Talk Podcast.
Today we're looking at Airship AI Holdings, or AISP. This company is squarely focused on AI data management, especially for mission-critical security stuff. The big question we're tackling is, given their growth path and where they're valued right now, is it a good time to buy?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Airship AI Holdings.
Yeah.
They sit right at that interesting intersection. Public safety, homeland security, and, enterprise data management.
Right.
They don't just sell cameras, you see. They provide these end-to-end AI-driven platforms. You might have heard names like Outpost AI, Acropolis, Airship Command.
Okay.
Essentially, they give these big organizations the ability to manage and, maybe more importantly, analyze just massive streams of video and other sensor data in real time.
And the potential market, the addressable market here, it seems incredibly broad, doesn't it? I mean, it's not just military or government.
No, not at all.
Our sources point to this, like rapidly increasing demand across places you might not immediately think of. Schools, big hospital networks, casinos even.
Yeah, logistics too.
And high-volume logistics operations. That kind of widespread need, it really suggests a powerful sort of underlying trend, doesn't it? Driving growth for years, potentially.
That's the secular tailwind. But, for a tech company, especially one aiming for these big enterprise and government clients, growth is almost secondary to the competitive advantage.
The moat.
The moat, right. What makes them different?
Well, Airship AI claims theirs comes from their proprietary AI and machine learning models. This is where we need to look a bit closer.
Okay, so tell us what makes their tech uniquely sticky, as they say. What specific job is their AI doing that maybe competitors find harder?
It's interesting. What seems fascinating here is the focus on proactive anomaly detection. It's not just standard motion tracking.
When you're dealing with something like, say, border security or these huge logistics hubs, the ability to train AI models to spot specific patterns of unusual behavior, not just in any movement, and then visualize that immediately, well, that's crucial.
And they package it all together.
That seems to be the key. Because they integrate the AI models with the visualization and the management tools, they offer this single unified platform.
Right.
Now, think about it from the client side. For a large government agency or a major company, putting in a system like this, it's a multi-million-dollar decision. It takes years sometimes.
Huge investment.
Exactly. So once it's woven into their critical infrastructure, the cost, the sheer hassle, the logistical difficulty of switching to someone else, it becomes astronomical. That is the real stickiness.
Well, that makes a lot of sense. They're selling a whole system, not just, a piece of software or a service.
Precisely.
But let's zoom out a bit, because this is a microcap company. And microcaps, they always come with execution risk, right? Looking at the top line, their revenue over the last year, the TTM, trailing 12 months, hit $13.72 million. Now, that is significant expansion for a microcap software player.
It is, no doubt. But this is where the story hits a bit of turbulence, this rapid growth.
Yeah.
It needs rapid investment.
Okay.
And the fundamental challenge, really common with these high-growth, early-stage AI names, is they're not profitable yet. Not even close sometimes.
How bad is it?
We're looking at a net income TTM of negative $44.01 million. That translates to an EPS of minus $1.52.
Wow, okay. 44 million loss.
Yeah. They are burning through significant cash, investing really aggressively in R&D, to maintain that tech edge you just asked about.
Wait a second. You mentioned valuation earlier. A forward price-to-earnings ratio of 41.75 for a microcap losing over $44 million.
Yeah.
That sounds, it sounds like pure speculation, like it's relying entirely on hope and a dream down the road. How do investors even begin to defend that kind of premium?
That's the critical question. Absolutely. And that high PE, look, it's only really justifiable if you believe two things are fundamentally true.
Okay, what are they?
First, you have to believe their tech is truly disruptive, a game changer. And second, you have to believe that those multi-year sticky government contracts we talked about, that they will eventually translate into massive margin expansion.
So it's a bet on the future payoff.
Exactly. Investors are essentially betting that once the heavy R&D spending levels out a bit and the recurring revenue from these big integrated platforms really starts kicking in, then the current losses will snap pretty quickly into high profitability. It's a calculated bet on future scale.
A very high-stakes bet, it sounds like. Now, let's look at their financial health, the balance sheet. They're currently valued around, what, $171 million market cap?
$171.22 million.
And they report no material long-term debt, which actually seems quite conservative for a company burning cash like that.
It is. It's good discipline. But they did recently announce a pretty vital financial injection, didn't they? Something about warrants.
They did, yeah. Just recently, they secured $9.7 million in gross cash proceeds. This came from exercising outstanding warrants.
And that's crucial, isn't it? For a company running losses like this.
Oh, absolutely.
Getting almost $10 million in dry powder, that immediately improves their financial flexibility, extends their runway, how long they can operate before needing more cash.
And it sends a signal too, right?
It does. It also signals that sophisticated institutional investors, the ones holding those warrants, they're willing to effectively double down on the company's future prospects right now at these levels.
That cash is absolutely essential for actually doing the work on those contracts they just landed.
Exactly.
And speaking of execution, this brings us neatly to maybe the biggest, most exciting catalyst right now, that government contract momentum.
Yes, this is where the story gets really interesting lately. The company is definitely riding some significant tailwinds in federal spending, public safety, homeland security, particularly as agencies are pushing hard to upgrade their intelligence and surveillance tech.
And it's not just talk, right? This became very real recently.
Very real. This materialized back in September 2025. Airship AI was awarded a massive $11 million in firm fixed-price contracts.
Okay, let's spend a moment on that $11 million figure. Because our sources were stressing this wasn't just one big deal that landed in their lap.
No, that's key.
It was, 16 separate awards coming from really mission-critical agencies, Department of Justice, Department of Homeland Security. What does getting 16 separate awards tell you about their technology and their position?
What it implies proven scalability and, crucially, diversification of validation. A single large contract. Maybe it's an anomaly, maybe it's one specific fit.
Right, could be luck.
Could be. But 16 separate awards across different parts of DOJ and DHS for things like border security, national security operations.
Yeah.
It demonstrates that the technology isn't just validated in theory, it's being adopted across varied and very demanding mission sets.
So it works in different real-world scenarios for these critical users.
Exactly. They're providing real-time, potentially national-scale detection capabilities.
Yeah.
And that level of client validation from those kinds of clients, it fundamentally changes how the market should view their risk profile.
It sort of transitions them, in perception at least, from just another software vendor to potentially a key piece of the federal tech infrastructure.
That's a good way to put it.
That level of trust has got to be priceless, and maybe helps justify that aggressive forward PE we were wrestling with earlier.
It certainly helps build the case for it, yes.
Yeah.
Precisely. Now, let's look at how the market is actually translating all this news into, price action. We have to consider the technical setup.
Where does this stand now?
As of October 31st, the price was around $4.85.
And analyst sentiment. Given those contracts, I'd expect it to be pretty positive.
Decidedly bullish, yeah. Not surprising. We're seeing a consensus of strong buy or buy. The average 12-month price target is sitting at $6. That suggests, nearly 20% upside from the current price.
Okay, and the chart. What's the technical picture look like?
Well, from a technical perspective, the stock's been kind of consolidating lately, trading pretty consistently near its recent lows in a range between, say, $4.82 and $5.12. Critically, though, it is sitting right around a very key level, the 200-day simple moving average, which is at $4.81. That's often seen as a major line in the sand for traders.
And it's holding above it.
Just about, yeah. It's also significantly above the year-to-date low, the support level, way down at $1.90. So it's come a long way, but seems to be finding a base here.
So if it manages to stay above that $4.80 level, what does that stabilization, that consolidation suggest about investor behavior? Is this what traders sometimes call a coiled spring? Getting ready for a move?
It can be, yeah. That's often the interpretation. Stabilization above a major moving average like the 200-day. It suggests that the bulls, the ones who believe in the long-term story, especially factoring in those new federal contracts, they're likely accumulating shares here, quietly buying.
Positioning themselves.
It's exactly. Positioning for the next positive catalyst. If they get some good news, well, the first obvious target would be that analyst consensus around $6.
And beyond that.
If there's real momentum, strong volume, we could see technical resistance potentially breaking out toward the $8.22 range. And, importantly, The Relative Strength Index, the RSI indicator, it's pretty neutral right now, around 50.76.
Meaning there's room to run before it looks overbought.
Exactly. Plenty of room for a major rally before the technicals start flashing warning signs.
Okay, this leads us directly then to the most immediate and probably the most critical short-term event on the horizon, the Q3 earnings release, scheduled for November 13th, 2025. This date feels absolutely pivotal.
It really is. It's pivotal because investors, frankly, they need to see tangible results. They need proof that the massive government validation translates into dollars and cents.
What specifically will they be looking for?
Two key things, primarily. One, robust revenue contribution starting to show up from that recent $11 million contract batch. And two, clear signs of margin expansion, or at least, controlled expense growth. Evidence they're managing the costs of delivering on these contracts.
And if they deliver.
A strong beat on revenue may be coupled with guidance that shows a clear path toward narrowing those big losses we talked about.
Yeah.
They could really send the stock significantly higher because it would validate that whole high forward PE thesis.
Right, proof of concept financially. Now, beyond the confirmed news, we should probably touch on the speculative chatter out there, because financial forums and social media are definitely buzzing. That contributes to the volatility, too.
Oh, for sure. You always have that with these kinds of stocks.
We're hearing whispers of major contract expansions, maybe even more deals with the government stacking up, or maybe launching some international pilot programs.
Yeah, I've seen that, too. And we've also seen chatter about potential M&A interest, from large strategic buyers or maybe private equity firms.
Why would they be targets?
Well, their unique AI platform, especially now that it's been validated so strongly by DHS and DOJ, that makes them a potentially very attractive tuck-in acquisition for a larger defense contractor, or maybe a big tech firm that wants immediate, credible access to the federal market.
Makes sense.
However, and we really have to stress this, these remain totally unconfirmed, speculative rumors. They absolutely should not form the basis of any actual investment decision. Treat it as noise for now.
Okay, fair warning. Now, let's balance all this optimism. When we're looking at a rating that's, 8.5 out of 10 bullish, we absolutely need to dedicate serious time to the risks. What are the major pitfalls here for someone looking at AISP?
I think the primary risk really comes down to execution, and that's driven mostly by the current unprofitability. Look, converting $11 million in fixed-price contracts into profitable, sticky, recurring revenue, that's hard work, especially when you're building custom proprietary systems for incredibly demanding government clients.
Right. Delays, cost overruns.
Exactly. Delays or cost overruns could quickly eat through that $9.7 million in cash they just raised. That runway isn't infinite.
And just being a microcap itself, the volatility, that's a risk factor on its own, isn't it?
Oh, absolutely. You've got typically lower trading volume, what they call low float, combined with high investor enthusiasm and all that speculative chatter we mentioned. It means the price action can just be extremely violent, both up and down.
So a single disappointment.
A single failure to meet earnings expectations, even by a little bit, could cause a really outsized, painful correction in the stock price, much worse than you'd see with a larger company.
And the tech itself.
Finally, you have that constant threat. Technological obsolescence. The AI field, it moves incredibly fast. Blink and you miss something.
So a bigger fish could come along.
If a larger, much deeper-pocketed competitor, think Palantir, maybe even Amazon's AWS or Google Cloud, if they suddenly decided to pivot hard into this specific federal surveillance niche, Airship AI's proprietary edge could potentially be neutralized very quickly.
They have to keep running just to stay in place.
They have to perpetually invest heavily just to stay ahead, which means that heavy R&D spending, and therefore the losses, they're unlikely to just disappear overnight. It's part of the business model for now.
Okay, so bringing it all together then. The overall rating we're seeing is bullish, right? Sitting at 8.5 out of 10.
Quite bullish.
But it's a bullish rating that clearly requires constant vigilance, particularly on execution. The core investment thesis seems driven by, 1, those powerful secular AI tailwinds.
Right.
2, the clear government validation via those 16 contracts.
Very important.
And 3, a technical setup that looks pretty favorable, consolidating above key support levels right now.
Yep.
So this potentially makes it attractive for, say, short-term trading, maybe playing the run-up into that critical Q3 earnings report we discussed.
Could be.
But it also has the potential, if management really delivers, to be a strong long-term hold. If they prove they can convert that validation into actual sustainable profitability.
That's the key question.
Which leads to the final thought. If the company can successfully translate its recent $11 million in federal contract awards into accelerated, predictable, recurring revenue streams, does the execution risk associated with its current unprofitability, that big $44 million loss, does that become a much smaller concern as we look ahead into 2026?